Hi and welcome back to the channel. I hope everyone's doing good. Today's video is going to be giving a brief overview into 3 UK stocks which I think look like good buys as we enter into November. As always though, I'd encourage you to do your own full research into these companies if you like the look of them. If you enjoy this video and get some value out of it, please drop it a like and subscribe to the channel. Stock number 1 is Barclays, who are one of Britain's leading banking groups who are organised into 3 main sectors: commercial banking, financing, investment and market banking, who complete various activities such as portfolio management, transactions and stock trading, and finally credit cards issuing. Barclays are a worldwide brand that have over half their revenue come from the UK, 11% from Europe, 33% from America, with Asia, Africa and the Middle East equating to around 5% of total income. Barclays share price over the last 5 years shows a chart which has been pretty range bound, not really showing an overwhelming trend in one direction or the other. If you'd bought this company 5 years ago, you'd be down around 18%, excluding any dividends that you would have received. Market cap is around 23.77 billion, PE ratio of 4.89, and the dividend is currently yielding over 4%. Barclays' financial performance hasn't been spectacular either, which would mirror its share price performance. Between 2018 and 2019, revenue was pretty flat, but exceptional performance in 2021 could be seen here due to the pent-up demand caused by the initial COVID lockdowns. Using Simply Wall Street, analysts are pretty bullish on top-line growth, where in 2024 revenue should be reaching close to £26.5 billion, with earnings being pretty resilient at around £5.2 billion. The financial health check gives it a 3 out of 6, with asset level, allowance for bad loans and low-risk liabilities being flagged up here. Short-term liabilities of £1.2 trillion do outweigh short-term assets of £970 billion, but long-term assets of £575 billion do outweigh long-term liabilities of £465 billion. With the screener flagging up debt of £836 billion as this exceeds the current cash position. Barclays recently beat Q3 earnings expectations. The bank reported a profit of £1.97 billion compared to £1.86 billion a year earlier, and against a company-compelled consensus of £1.81 billion. Impairment charges for the quarter rose to £381 million, an increase of £120 million a year ago. On a 9-month basis, the charge for potential bad debts rose to £722 million compared to £622 million last year. Group income rose 17% to £6.4 billion, driven by the increases in interest rates. Net profit for the quarter was up to £1.51 billion, up from £1.37 billion. Net interest margin, the difference between rates on loans and deposits, reached 2.78% from 2.53% a year before, and the surge in profits come as the central banks increase interest rates in an attempt to stop runaway inflation. Income at Barclays' bond trading division soared to £1.5 billion, largely due to the turmoil caused by the UK government's disastrous mini-budget last month, reflecting higher levels of activity as we supported our clients through a period of market volatility. And this bottom section mentions the blunder from earlier in the year due to a trading blunder which saw them agree a penalty of $361 million with US regulators for what was described as staggering failures that led the bank to oversell nearly $18 billion worth of investment products, which in this year alone has cost them £600 million. One of the main reasons I like Barclays and the banking sector as a whole is that this sector will benefit from rising interest rates. As rates rise, this changes the economic and investing landscape, but with the combination of how well most banks are structured these days compared to the 2008 financial crisis, and the fact that they've been forced to navigate and make money in a historically low interest rate environment, I now see this as a real opportunity for banks. By owning Barclays, you'll benefit from dividends which get paid out in April and September. These dividend payments vary depending on the bank's performance, but over the last few years it's been between 3 and 6 pence per share over the course of the year. TipRanks have 11 analysts covering this one, with 7 rating Barclays a buy and 4 a hold, giving an average price target of £2.37 per share, given over 55% from current levels. Stock number 2 is National Grid. National Grid specialise in owning and operating electricity and gas networks. It does say that net sales are broken down by 63% of revenue coming in the US and 36.3% in the UK. But over the last year or so, National Grid has been manoeuvring assets around to be more heavily weighted towards the UK, so this may be slightly outdated. Earlier in the year, they did agree to sell a 60% equity interest in its UK gas transmission and metering business, and by doing so, it increases their portfolio towards electricity and will help towards their net zero targets. And good news for shareholders, as it will also help support a strong balance sheet, strong investment grade rating, and a sustainable dividend. And this pivot towards UK electricity being a priority is mirrored by the sale of some existing US assets and purchased PPL's UK infrastructure under Western Power Distribution. National Grid's share price over the last 5 years show it being pretty flat, edging out a 2% gain at the time of this video. Its market cap is around 34 billion, PE ratio of 15.5 and a very generous dividend on offer of nearly 5.5%. Looking at the share price over the last year, as we entered into 2022, share price performance was pretty good and it held up well against the overall market, and up until around May, where things started to go a bit pear-shaped, it was sitting at around £12.50 per share and it's now come down to £9.37. The revenue and earnings had been decreasing since 2019, but last year recorded superb results, where revenue and earnings were the best they've been in the last 4 years. National Grid mentioned this month that trading for the first half of the year was in line with expectations and forecast annually underlying earnings to be more marginally weighted towards the second half rather than usual, after including a full 6-month contribution of National Grid Electricity Distribution, formerly Western Power Distribution. The company added that results would also include a contribution from Rhode Island up until the completion of its $5.3 billion sale to PPL. Earnings aren't due out until November 10th, so certainly worth taking a look at these when they get released. Back to Simply Wall Street, and 11 analysts on here expect revenue and earnings to be continually improving from this point out till at least 2025, where revenue could be sitting at above £20 billion for the year. When you look into utility companies, nearly all of them flag up as being terrible in all financial health checks due to their combination of high debt, low cash levels and being affected by rising interest rates. They do, however, offer resilient income through good and bad times, as well as owning large amounts of physical assets. And this exact point can be seen here by the short-term liabilities of £24.7 billion, outweighing short-term assets of £17.96 billion, but long-term assets of £76.9 billion outweigh long-term liabilities of £46.23 billion. Debt of £45.9 billion has been flagged up on the balance sheet check, which would be the case for pretty much all utility companies. Income-focused investor would be appeal to a company like this, where since 2018 it has been growing its dividend slowly each year, where it was 45.93 pence in 2018 to this year it is now 50.97 pence. Payments occur twice through the year, once in January and secondly in August. The energy market as a whole is a bit wild at the moment, especially the cost that consumers are now expected to face, and in the UK from now until April a price cap is in place which caps the price at around £2,500 for the average household, which will help assist families struggling to cope with surging inflation and spiralling energy costs. And this takes us on to some of the pros and cons of owning shares in a utility company. The pros are the high stable dividends that you'll receive, but the cons are that utility and energy companies are always under scrutiny to keep prices reasonable, and they're often seen as the bad guys. Every few years the government also seems to want to make the case that they view utility companies would benefit from being government owned, which is something that I don't agree with. Tip ranks of 4 analysts covering this stock, with 1 buy rating and 3 hold ratings, giving an average price target of around £10 per share, which from current levels would give you just under a 7% return. And finally, the last company I have for this month is AG Barr, who are a UK-based branded consumer goods company which are involved within the soft drinks business. They consist of brands such as Iron Brew, Bundaberg, Barr Flavours, Rubicon, Strathmore and much more, and it's got a strong Scottish connection which we'll touch on. Coca-Cola outsells every soft drink in almost all countries around the world, but there are at least 3 brands that have defended its home market, and that's exactly where Iron Brew comes in. It is a traditionally Scottish drink and it's named Scotland's other national drink after whisky. And when you think of how well Coca-Cola performs across the globe, to be able to outperform this massive company shows that AG Barr have a bit of a moat with Iron Brew, especially within Scotland. AG Barr's 5-year performance shows that you'd be down almost 30% since 2018, and over a 1-year period you'd be down 10.5%. AG Barr currently has a market cap of 492 million, PE ratio of 14.3 and a dividend yield of around 2.8%. Revenue and earnings are rebounding from 2 main events, which the big one is obviously the COVID lockdowns, but secondly UK sugar tax, which came into play in 2018 by the UK government, and it forced UK soft drinks companies to change their formulas in order to combat obesity. 6 analysts on Simply Wall Street show that they expect revenue out to 2025 to be continually increasing year over year, where in 2025 is expected to be around £332 million. AG Barr passes all 6 financial health checks. It has short and long term assets well outweighing liabilities. And we're also getting all green pass marks across the board, show that this company is very well financially positioned. They reported strong earnings, which showed a 16.7% improvement in the first half revenue to £157.9 million. With strong sales recorded in both of its business units, it reported profit before tax had expanded 1.2% on a year-over-year basis to £24.7 million, and its adjusted profit before tax jumped 22.8% to £25.3 million. Operating profit margin was stable at 16.2%. Cash and cash equivalents at the end of the period stood at £61.3 million, down 6.6% on a year-over-year basis, and adjusted earnings per share surged 48.5% to 18.98 pence. The board declared an interim dividend of 2.5 pence per share, and operationally, Barr recorded strong sales momentum across both of its business units, with Barr soft drinks up 12.3% and Funkin up 21.4%. It benefited from year-over-year COVID recovery and noted that they made a very strong start to the year and continued to see good momentum across the business and its brands. Dividends get paid out on 2 occasions throughout the year, once in June and the other in October. Over the last few years, the payments have varied, but now look to be back on track, and backed with strong financial fundamentals, they should remain consistent. Brand growth shows that the top brand of Brew had grown at 5.6%, Rubicon grew at a staggering 23.8%, and Barr Flavours grew at 13.4%. Funkin, their strategy into the ready-made cocktail market, had fantastic results, which show on-trade growth of 23.5%, at-home growth of 17.3%, and international sales doubled, with a US initial state planning to be trialled in 2023. AG Barr also have entry into the growing plant-based milk market with early-stage investment in MoMA. 32% of Brits are estimated to now be drinking plant-based milk. The oat milk category itself had 16% growth, and MoMA, as a result of that, had growth of over 30%. TipRanks only has one analyst on this company, and they're pretty bullish on it with a buy rating and average price target of £6.10, which would give you around 37% to the upside from current levels. And that will take us to the end of this month's picks. I hope you've enjoyed the look into these companies, and I'll catch you all in the next one. Cheers.